Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 123, titled Implied Volatility, IV rank, and IV percentile, defined and practical applications. Now, most of you who have followed BCI over the years know that we do put a heavy emphasis on implied volatility. But what about IV rank and IV percentile? Many of you have written to me asking me about these statistics, so I decided to create this video describing what they are and what applications, if any, they have in our option selling portfolios. Let's first talk about the significance of implied volatility, or IV. The amount of IV is directly related to our option premiums. The higher the IV of a particular security, the greater the premiums. That's the good news. But the higher the IV, the greater the risk to the downside as well. So how much risk are we willing to take? And that's where we have to make decisions regarding our initial time value returns. What is appropriate for us? It may not be the same as what's appropriate for another trader. So once we make that determination and define our initial time value return goals, we have in essence defined the amount of implied volatility we're willing to have in our underlying securities. Now, implied volatility can also be evaluated in a historical perspective, and that's where IV rank and IV percentile come into play. So let's run off a few definitions now. First, let's start with implied volatility, the most important one. This is a forecast of the underlying stocks or ETFs volatility as implied by the options price in the marketplace. So how much is expected that stock will go up or down based on the option pricing. And it is generally based on a 1-year or annualized perspective and one standard deviation, meaning that the range should be accurate 68% of the time. So one year, one standard deviation. So if we're looking at the implied volatility of a security under a specific contract time frame, we would have to then use a conversion factor to convert to the IV for that particular contract. But that's something that I've addressed in many articles and webinars and videos and so on and so forth, beyond the scope of this particular podcast. Let's next define IV rank. This is a measure of the current implied volatility in relationship to its 1-year high and low. So as an example, if the IV is 20% and the 1-year range is 10 to 40%, the IV rank then becomes 33%. Here's the formula. We take 100, multiply it by the current IV, subtract the 1-year low, and then divide it by the 1-year high minus the 1-year low. Wow, that's quite a formula. Here's how it would work in this hypothetical. We do 100 times 20 minus 10. 20 is the current IV and 10 is the low for the year. And then we divide that by 40 minus 10. And that becomes 33%. Now, the IV percentile is the percentage of days that the IV is below the current IV in the past 1 year. It doesn't factor in the high and the low, as does IV rank. So if the current IV is 30% and 200 out of the last 252 trading days, that's the number of trading days in an average calendar year, the stock's IV was below 30%. The IV percentile is 79.4%. Here's the formula. The number of days the IV is below the current level divided by 252. In this hypothetical, 200 divided by 252. That comes to 79.4%. Now, I'm showing a screenshot for those of you also watching this podcast of where this information can be accessed at your brokerage account. This particular screenshot is taken from schwab.com. You could check with a rep from your broker to see where this information is located. You'll ask for the IV rank, and IV percentile if you feel this information is important in your trading system. So what about general applications? Well, some option traders will use IV rank and percentile to determine which strategies to use. For example, if a stock has an especially high IV rank or percentile, a strategy may be selected to take advantage of what's called mean reversion concept that suggests a return to average. So is the implied volatility, do we figure that it's going to decrease or increase based on the rank and percentile? So strategy selection is really where these two historical applications can be used. But we already have our strategies. We're using covered call writing, and we're selling cash secured puts for the most part. Those are what members of the BCI community are using. So we don't really need IV rank and percentile because we already have our strategies already defined. So it can, but I don't want to say that IV rank and percentile have no application. It does, but it's more in terms of determining or defining a particular strategy that we're going to use. That's not the case with most of us. So let's talk about applications for covered call writing and selling cash secured puts. Well, wow, is implied volatility important to us? You better believe it. But not so much IV rank and percentile. Why? We're taking a 1 week or a 1 month obligation, and then we're reevaluating our bullish assumptions of the underlying securities on a very, very frequent basis. We have our initial time value return goal range already defined, which will actually define the degree of implied volatility we're willing to undertake, therefore the amount of risk we're willing to undertake. That's already been predefined before we enter our first trade. We also have our buy to close limit orders in place to protect us against share price decline. That's the 20%, 10% guidelines. Remember, we've screened the heck of out of our stocks. We've used fundamental analysis, technical analysis, and common sense principles to create a watch list of eligible securities for option selling. So my submission to you is that by adding historical perspective of our options could very well be a case of analysis paralysis. But it's important to understand what they are and why we're not using it, if those of you who agree with me on this particular point. So that said, let me end my podcast, as I always do, by bragging or mentioning about our BCI package, an acronym for our best and most comprehensive investment package ever offered by the blue collar investor. Contains 18 items. Here they are. 6 online video courses, all with downloadable workbooks, covered call writing and put selling. 6 calculators developed by the blue collar investor and therefore found nowhere else. 5 of our best-selling books in ebook format, and our annualized premium membership, which contains 4 reports, 2 weekly, 1 monthly, 1 quarterly, on eligible securities for option selling, along with expanded calculators and dozens of additional files and resources, along with our very important online training program, where we have over 200 training videos and add at least 1 additional training video every month. You could find out more information and where to get the BCI package on our website, www.thebluecollarinvestor.com. Click on the link that says BCI package. For those of you who want to purchase items individually, you can go to our store, www.thebluecollarinvestor.com/store, and there you will see our online video courses, our ebooks, our calculators and spreadsheets, all developed by the blue collar investor, our soft and hard covered books, and information on our one-on-one mentoring program. Ladies and gentlemen, thank you very, very much for taking the time to watch and or listen to this BCI podcast number 123. This one titled Implied Volatility IV, IV Rank, and IV Percentile Defined, along with practical applications. Folks, I hope you enjoyed this presentation, and more importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.